export those quality products abroad so that they become globally competitive. So the main concentration is to promote small and MSME, micro, small, medium enterprises. So business finance refers to all those activities in which business capital is acquired. Hello everyone, this is Purna Chandra, Faculty, Department of Commerce and Management, Vidhyaashram, the Temple of Excellence. So we are dealing with the subject Entrepreneurship Development for 5th Sem BCom, and today we are starting a new unit, that is Unit 3, and today will be your first session in Unit 3. So the name of the unit is Financing of Small Business in India. So let us start. So next, the topics which we are going to cover today are the various modes in which small business can be financed, your SFCs, what is SFC, your SIDBI, and also NBFC. In detail we will be understanding in today's class. So we will start. So before we get into the unit, we will understand the basic meaning of what is business finance. So we will see the meaning. Business finance is a business activity which is concerned with the acquisition of capital funds. So here there is a word called acquisition of capital funds. So capital is the initial investment with which you are starting the business. To start, you need capital. So to get capital, you have to acquire it in some way or the other. So business finance refers to all those activities in which business capital is acquired. The main aim is to meet the financial needs of the business entity. Obviously, without finance, your activities cannot take place. So you need to arrange finance. So this refers to business finance. So next we see the sources of business finance. So here there are mainly two main sources. We will understand one by one. First one is your equity sources. Second one is your debt sources. So we will understand what is equity sources. So here it is the money or capital that is contributed by the owners. That is, owner, he puts his own investment. So for example, he is having some money which he has pooled in the previous years. So he is investing his money in the business. So that we call it as equity sources. Then what is debt sources? So we will understand. So here it is the source of funding that requires the money borrowed to be paid back with interest. That is, debt means your loan. You are taking loan from some other people, and after some time you will have to repay that loan along with the interest. So this is debt sources. Equity is you are putting your own money. Debt means you are going for a loan. So next, equity sources. There are various equity sources which we have to understand. The first one is your personal savings. So you might be having your personal savings which you have collected in many years. So you want to invest it in business. So this refers to personal savings. Next, friends and relatives. So your investment is not enough. You want to invest more. So you approach your friends and relatives to invest in your business. Then you go for partners. So you can get it registered, minimum 2, maximum it is 50 in the latest act and it is 20 in the previous act. You can also start a small business in partnership. You can make agreements, you can bring in capital, and you can share the profits. That is partners. Angel investors. Who are angel investors? So basically angel investors are investors who are having crores of rupees with them and they are ready to invest in business. So usually they are wealthy individuals willing to invest in local business. That is, they want to invest money in local ideas and make it big. That is angel investors. Then venture capitalists. Who are venture capitalists? So venture capitalists, they invest money for ideas. So investors who provide capital to companies with high growth potential. That is, if there is very good idea with some people, they don't have finance. What venture capitalists do is they finance the idea and they make it a success. This is regarding your venture capital. So next we go for debt sources. Debt is you are acquiring loan and you will have to pay it back with interest. So here the first debt source is bank. You can approach any private sector bank or nationalized bank. Based on your idea, you will have to give some collateral or you have to mortgage some papers and you get the loan. Trade credit through vendors. So what is basically credit? Trade credit means they will give you materials on credit or they will give you money. So and you will have to repay it back. That is trade credit through vendors. That is, you can procure raw materials or anything of that sort and you can make the payment later. Next, finance companies. There are private finance companies, lot of companies like your Tata Capital or your Muthoot Finance, where you can mortgage your gold or any documents and you're getting loan for the business. Next, there are credit unions, mainly in the form of cooperative societies, who will give you loan at low interest rates. Government agencies. So what does government agencies, how it will help small business is guarantees up to 90% of the loan if the business fails. Now what happens? You take loan, for example, you take a loan of 10 lakhs and you're not able to repay it back because your business is a flop or it did not succeed in the market. So now what happens? 10 lakhs you will have to repay it back. So there are certain government agencies who will guarantee up to 90% of the loan if the business fails. That is, if you approach these agencies, if it is 10 lakhs, 90% the government will waive off. So you will have to return only 1 lakh out of 10 lakhs which you have taken. So this is government agency. 90% of the loan is covered by the agency. Your liability is only 10%. So next we go for institutions helping small business. So for the first institutions which we are dealing in today's session is State Finance Corporation, also known as SFC. In India there are 18 state finance corporations. So totally there are 18 state finance corporations. It promotes small and medium industries of the states. So the main concentration is to promote small and MSME, micro, small, medium enterprises. It helps in balanced regional development. So obviously they want to encourage more number of small industries in rural areas so that people in rural areas also get developed. And higher investment. They want entrepreneurs, prospective entrepreneurs with higher investment. So they want people to invest more so that they can earn more. And employee generation. Employment generation means more number of small scale industries, more number of employment. More employment means more income. So this will improve the economic conditions of people in rural areas. So usually SFC's 10 directors are appointed to manage one SFC. Next, state government appoints managing director in consultation with RBI. That is, here the regulatory authority is Reserve Bank of India or RBI. What state government does is, along with RBI, it will appoint a managing director who is in charge of these SFCs. So next, functions of SFCs. What are the different functions provided by SFCs? Provide loan for acquisition of fixed assets like land, building, plant and machinery. You want to purchase land for your business, you want to purchase machineries and you want to build building, they are there to give you the loan. So next, provides financial assistance to industries whose paid up capital does not exceed 3 crores. So any financial assistance required to industries whose paid up capital is within 3 crores, these people are there to give financial assistance. That is, the paid up capital, if it is not exceeding 3 crores, they are here to give you financial assistance. Next, they grant guarantee loans repayable within 20 years. That is, they provide you loans which you can repayable within 20 years. The term of the loan will be 20 years, not more than 20 years. So the next function of SFC, all SFCs are dependent on rules and regulation made by state government. So all rules and regulation will be made by state government and central government will not interfere. Next, all SFCs in India is tied up with World Bank and World Trade Organization agreement. So whatever rules and regulations are made by World Bank and WTO, all the policies have to be followed by SFCs. They cannot violate the rules of World Bank and WTO, that is World Trade Organization. So next, institutions doing small business, the next institution which we are dealing is SIDBI, that is Small Industries Development Bank of India. So what is it basically? So it is an independent financial institution aimed at aiding MSMEs. So it is an independent institution. The main motto is to help small and MSME, that is micro, small, medium enterprise, and it was set up in 1990 under an act of the Indian Parliament. That is, it was proposed in the Parliament, and finally in 1990 the Indian Parliament, they gave way for SIDBI. So next, functions of SIDBI. What are the different functions that SIDBI gives? First one is, the aim is to make SMEs globally competitive. That is, it wants MSMEs to produce quality products and export those quality products abroad so that they become globally competitive. Next, strong and vibrant. They want MSMEs not to come out with poor quality products and service. They want the MSMEs or the small business to become very strong and vibrant so that they can compete in the international market. Next, protect MSMEs as a customer-friendly financial body. That is, whatever problems small or medium enterprises are having, SIDBI is always there as their friend, and it wants the small industries to consider SIDBI as a friend and solve any project or any problems that arise in the small industries. So SIDBI is always there to help the small industries. Next, provide modern technology platform. So certain people who are starting small industries, they are not having knowledge regarding the modern technology. So what SIDBI does is, it gives them knowledge regarding the modern technology and also helps them to implement the modern technology in their business. The third point is, it coordinates the function of institutions engaged in small business activities. So there are various small business activities, whether it is production, marketing or finance. So what it does is, it coordinates the function of different small business activities. Next, SIDBI is one among the top 30 development banks of the world. So it is one among the top 30 development banks in the world. Next, it does direct financing by way of service sector financing. It is not only confined to products or manufacturing of products. So SIDBI will also give you financial aid if you are into service sector. Next, it focuses on credit plus approach, which includes technology, modernization and upgradation. So credit plus approaches, it will give you loan or credit to upgrade to the latest technology. Suppose you are having a business, you are using some old technology, you want to upgrade it to the latest one. So they will provide you credit plus approach. Then cluster development. So if you are a few people, you want to start your own industrial estate or a cluster of industries, they are there to help you financially. Then enterprise development, that is, enterprise means your business or your entity. So you want to start a small industries, so they are always there to help you regarding the infrastructure, plant and machinery, etc. Next, upgrading skills. Just investing money and coming out with technology and products is not enough. So you need quality and skilled workforce. So quality and skilled workforce can only be achieved by upgrading the skills. So if you don't upgrade the skills of the employees, what happens is, you won't be able to compete with your competitors. So what SIDBI is, it gives training to the workers so that they upgrade their skills. And support marketing activities. SIDBI also helps in marketing activities by helping in advertisements, publicity, personal selling or sales promotion. So next we go to NBFC. So basically what is NBFC? Non-banking finance company, meaning of NBFC. It is a company registered under the Companies Act 1956, that it is registered in the previous act of 1956. So it is a private company and it is not any government company. So what happens here is it is engaged in the business of loans. So on mortgage, on collateral, they provide loans to start small business entities. Acquisition of shares and debentures. So they are also indulged in acquisition of shares of big companies and also debentures. Then equipment leasing. They provide equipments on lease basis. That is, you deposit some money, you take the equipment. After usage for 6 months or 1 month, you have to give back the machinery in the same condition and take back your money. That is equipment leasing. Then hire purchase. So hire purchase, in the previous class I have already explained. You make some down payment for the machinery, remaining amount you can pay it in EMIs, and the ownership will be transferred only after you pay the final EMI. Then business insurance. There are a lot of insurance which you can do in business, like your fire insurance or product insurance, marine insurance. So these people are also involved in that. Next, chit business. So lot of local people, they are also indulged in chit business. So it is also indulged in chit business. So next, NBFC. You will understand the features. It receives deposits under any scheme. So any scheme of the government, it will receive. That is, any scheme that is implemented in nationalized banks like your SBI, Canara or your Union Bank, the same schemes, it will also receive deposits. It should be registered with RBI to carry on any business of non-banking financial institution. That is, if there is an NBFC, it has to be registered with RBI for it to legally operate. So if it is not registered with the RBI, then it becomes illegal. Next, NBFs are allowed to accept public deposits for a minimum period of 12 months and maximum period of 60 months. That is, deposits can only be accepted. Minimum period is 1 year, that is 12 months. Maximum is 5 years, that is 60 months. More than that also they cannot accept. Less than the bracket also they cannot accept. So next, NBFC cannot accept deposits repayable on demand. For example, one person, he puts a deposit in NBFC. That is, for example, deposits of 50 lakhs for 5 years. That is, he can take back the deposit only after 5 years. Within that 5 years, if he demands the deposit, it cannot be given back to him. That is the meaning. Cannot accept deposits repayable on demand. NBFC cannot offer interest rate higher than the ceiling rate prescribed by RBI. That is 11% per annum. They cannot charge interest rate on loans. So here what is happening, there is a ceiling rate that has been prescribed by the RBI. So more than that they cannot take interest on loan. So maximum is 11% here. NBFC cannot offer gifts or incentives or any other additional benefits to the depositor. Now there is a prospective depositor. Just because he has deposited 50 lakhs or 1 crore in a NBFC, that doesn't mean the NBFC company can give them personal favors like gifts or incentives. That is illegal. So next, we go to types of NBFC: mutual benefit financial company or Nidhi companies. So these companies will be having lot of monies and profit is not the motive, service is the motive. So any person approaches them, they give loans. That is the thing. Investment company, they indulge in your mutual benefits. They take money from the people, invest in your mutual funds or shares. They make money and they help people. Equipment leasing company, already I have explained. People buy machineries on lease. They give money. After they give back the machine in the same condition, they get their money back. Then hire purchase, you make down payment and payment in EMIs, you get the machine. Then loan company, they give loan, secured loan and unsecured loan. Secured is there is mortgage, there is collateral. Unsecured means just on goodwill they give loan. Next, miscellaneous non-banking companies like chit fund business. So this is operating at very local level where people, they are indulged in chit fund. Then housing finance to constructions of house. If you pledge the land property, they will give you loans. Then currency exchange like your Centrum Bank or Forex. So you want to transfer money from India to US. One of your family relatives are in US. So currency exchange, they will convert the currency of rupees into dollars, but you will have to give them commission like settlement rate. That is currency exchange. There are a lot of insurance companies in the form of NBFCs which are doing business insurance like marine insurance, etc. So these are regarding the types of NBFC. So in the next class, what we'll be understanding is venture capital, bills discounting and factoring. Thank you.